In this video, we are going to be reviewing some of the recent cases around money laundering in the crypto space. Um, Particularly, we'll focus on Tornado Cash. You may have heard of this. Took place throughout August, where Tornado Cash, which is essentially a crypto mixer, was allegedly allowing for foreign transactions to take place from cryptocurrency that was hacked, and a cryptocurrency that was or hacking operations that were state sponsored by North Korea to be able to launder money by way of Tornado Cash. So, what is a crypto mixer? Just a quick briefer. Um, the crypto mixers are essentially platforms that allow you to take anonymous inflow from of transactions and mix these transactions origins with one another and obfuscate them so that on the tail end of it, when the transaction goes through, it's not easily trackable. So Tornado was one of the forefront crypto mixers. It has, of course, since been added to the OFAC list, and it's obviously the Department of Treasury, and along with a number of other federal agencies, have been both tracking this and enforcing action for Tornado Cash and all affiliated operations. So this is directly a link to the Treasury website that you can review to read about this case. And then beyond that, there were some updates on that shortly after, where they were able to catch some of the lead developers for Tornado Cash as well. And they were arrested, of course. And this article goes over that. And then lastly, this just begs the question of what is sort of in terms of sanctions, in terms of laundering risks that takes place as well. What's kind of being done about this, and what are some things to keep in mind at being an investor in the space? So this Medium article written by Riyadh carries a very insightful one. It uses Kaiko research, which we really like at Pareto. Um, it goes into what are some of these risk vectors when it comes to crypto for offshore transfer of funds. Now, obviously, Tornado is one of the sort of the negative use cases and some of the operations that were unfortunately on the wrong side of the spectrum there. But on the other side of the spectrum, it's worth thinking about when it comes to sanctions. So recently, you may have heard last month, there were a number of sanctions that were placed on other stable assets, stablecoins, and they were enforceable. Now, as it happens, those specific stablecoins were centralized stablecoins, quote unquote. In other words, they were assets that were issued by a central entity, so that it was enforceable. The U.S. government was able to communicate with them and enforce action. But then you have things like decentralized stablecoins, or as this article goes over, wrapped assets. Now, wrapped assets are essentially a pseudo decentralized asset. So in this case, it's reviewing wrapped Bitcoin. Wrapped Bitcoin is essentially a way you can take other crypto assets and have it denominated in Bitcoin, such that you're able to engage in yield operations or so on that you may not be able to, let's say, on the Ethereum blockchain using your Bitcoin. So you wrap your Bitcoin, now you have some sort of notional exposure to, let's say, Ethereum or some similar ERC20 crypto asset, and then you can use that for lending protocols and so on and so forth. That has a clear, upside use case for investors who are looking to earn a yield. But the downside is that that does potentially expose you to risk from sanctions being imposed as well. Even if the sanctions are being imposed for, let's say, the purpose of money laundering, if you are engaging with wrapped Bitcoin, these are some risk vectors to consider. So again, this article goes over not just how some of these decentralized assets that are pegged to something else, particularly in the form of wrapped Bitcoin, works, but also risks of sanctions to average investors. As always, if you have any questions, please do not hesitate to reach out. Thank you.